So if it's not one thing, it's another, right? If you've watched this show long enough, you've heard me speak about any number of things that can derail you when you're trying to make it as a trader. And most of these are coming from my own experience. I kind of speak about them because I'm getting them, from as questions from folks either in comments on the YouTube channel or directly via email. Either way works. But man, it reminds me of how challenging it possibly can be, because even if you're in a winning streak, you can still kind of take a smashing and blow yourself up. That goes under the chapter of overconfidence. If you've read Market Wizards like I did a million times, you talked about Jack talks about how folks took their biggest losers right after they had their biggest winning streaks, and not enough is written about that and why that happens in the area of overconfidence. And I think it's the flip side of the coin of where, you're in a losing streak and you've had 4 or 5 trades go against you. So you can kind of get a little bit head shy. Maybe that hesitancy thing that we spoke about kicks in. And then next thing you know, you're afraid to put on the 6th trade, which turns out to be a winner of some magnitude. So then what happens, right? You start getting into that kind of pissy mood. And this one didn't actually happen to me because I was always fairly grounded, but it did. There was still a whiff of it in the air, and that is when you start to make money and you're keeping your risk on overnight and over the weekend, your account can grow really fast, more so than if you're scalping, for example. And all of a sudden, you'll sit there and be like, okay, I got this. I got this. This is what I'm doing it for. And at the end of the day, you realize like all you really did was put yourself in the right place at the right time and let the market do all the damn work. Because when the crowd shows up, we're going to talk about the crowd, they will put a lot of money to work behind you. And those institutions, when they're looking to execute a buy order, they're not just sending an order to buy 10,000 shares to the floor or maybe even 50 contracts. They might have to buy 500 to maybe 1,000 contracts. Maybe they're going to buy it across the strip. You never really know. But all that buying drives prices higher. And all you had to do is sit there and lay back and stay out of the way and let the buying pressure unfold. And then what happens is you start taking flyers or start taking trades because you feel now that you've developed some kind of sixth sense, which you might be on the way to actually doing, but just not necessarily in the short run. And then you start perhaps trading larger because you're in a winning streak. And so what ends up happening is sooner or later, whatever the criteria were that led to your having your monster wins, which I'm happy for you if you have them, that overconfidence can actually undermine you after a while, because it's when you kind of let your guard down. And that's why I talked a few weeks ago about consistent bet sizes. The consistent bet size thing is going to help you so much through all different types of mental tests that you're going to get, whether that be losing streaks, winning streaks, feelings of greed, feelings of fear. I think that's one thing, the constant bet sizing is one thing that can kind of keep you bulletproof in many ways from succumbing to any number of emotional or psychological things that can pop up for you, right? There's a couple of companies that have earnings reports this week. And some of you might be having a couple of losing trades. You might have had a couple of winning trades. Remember, I teach CFAs, and they can't predict with a great degree of accuracy where some of these companies are going to come in with earnings. So I think it would be a mistake if you think that you can. If your eye is looking for, bullish articles, that's all you're going to see. But if you have constant bet sizing, you'll make your money if that's the way it works out. But if you lose, you should, stay within your prescribed regimen of risk tolerance. The minute you start to think you're onto something with no particular kind of training, you're really opening up yourself to get hurt badly financially or frustrated. And we know those feelings too can kind of lead to overtrading. They can lead to all kinds of acting out and going on tilt. So before you keep pushing for Wednesday's earnings announcement, I'm not even going to tell you the name because I know you know it. Don't be stupid. If you haven't had great degree of success in what you're doing right now, don't make the mistake to think that you're onto something. It's your mind messing with you. And again, if you've had 2, 3, 4, I don't care if you've had 10 winners in a row. My hat's off to you. It's going to happen from time to time. If you trade long enough, it will happen. In the same breath, though, you're going to have several that are going to work against you. So don't let that pervade your thinking. If you're working with constant bet sizes, you know that whatever happens in your account should be in model, right? And this is one thing that backtesters have over, folks who are trying to do it by hand or do discretionary chart reading is they don't really know the numbers. They're kind of going on a leap of faith, which you kind of have to do if that's your path. So what ends up happening is the result of a particular trade might have a bigger emotional impact on you than it should because you're unaware of what the possibilities were beforehand. A backtester or someone who's put that work in and has tested his or her buying and selling decisions with their position sizing algorithm can backtest at the portfolio level going back any number of decades. You can go back 30 years. 10 is a minimum. But you have to remember in 2024, that only takes you back to 2014. That doesn't include, the subprime morass around 07, 08. It also misses, 9/11. So the more data, the better, because then the more robust your rules are. And with the back testing, you can kind of see, like, if these were your buying and sell decisions, these what the results could be. Now, that doesn't exactly mean for any degree of accuracy that's what you would have gotten, because we have to Monte Carlo simulate, because not everyone starts on the same day, right? You don't know what your starting balance would be. You can only do these hypotheticals, for example, but you have to do them. And in this way, at least you understand that if you traded, copper, or if you traded whatever the darlings of the day, if you go back far enough, it was the Four Horsemen, then it was GARP, or whatever they were called. Now we have Magnificent Seven. Like, it's almost as if the memes kind of pass the baton to one another to take up all the airwaves, of what's going on to kind of keep you entertained. But for everyone who's thinking about making big bets around earnings reports, my advice to you is to not do it. Because what you think you know and what you actually know, in my opinion, when you're starting out, are two very, very drastically different things. I'll be very bold in telling you I don't think you know anything. You can develop your instincts for sure, but you have to remember that we are speculators, and our job is to manage risk. If you lose your money, you lose everything, meaning you not only can't trade, but now you've lost your confidence. You've lost whatever psychological edge you might have had because you're done. So that's why most pros think, yes, of course you have to take risk in order to make money. And you want to think of rates of return on your account balance, not a rate of return on a particular name. But that the number one job is to play superior defense. If you go back and watch the episode on constant bet sizing, you'll see what I was getting at. Because the minute you start to overthink things, or start to think that you're onto something without any objective feedback from a desk manager or peers or a study group or a mastermind or something like that, you really can put yourself in harm's way. And I have a sense the audience that watches the show, they're working really, really hard. And I wouldn't want to see you throw anything away because of one bad trade, or you took a gamble and rolled the dice and put on a big trade, kind of hoping it was going to work out and, bring you this gigantic windfall. Your job, when you think about it, is to preserve your cash. You have to take chances, but don't let your sense of overconfidence blow you up so that you're betting too big or you're betting too frequently. That has been something that's hurt folks who are in market wizards, right? And chances are most of the folks watching the show, including the guy putting on the show, won't be at that level. So be careful, protect your capital, stay grounded, and use constant bet sizes. If you like this video, check out this one.